Welcome to Becoming Boss C. Today we will discuss Domain 5 for Part 1 of the Certified Internal Auditor Exam. Remember, Domain 5 makes up 35% of this exam, so you do not want to miss out on the key objectives discussed, and you definitely want to ensure you understand this domain. These are the syllabus objectives for Domain 5. A. Describe the concept of organizational governance. B. Recognize the impact of organizational culture on the overall control environment and individual engagement risks and controls. C. Recognize and interpret the organization's ethics and compliance-related issues, alleged violations, and dispositions. D. Describe corporate social responsibility. E. Interpret fundamental concepts of risk and the risk management process. F. Describe globally accepted risk management frameworks appropriate to the organization. Note that E is tested at a proficient level, which means that you all should know the content in greater detail. G. Examine the effectiveness of risk management within processes and functions. H. Recognize the appropriateness of the internal audit activity's role in the organization's risk management process. I. Interpret internal control concepts and types of controls. J. Apply globally accepted internal control frameworks appropriate to the organization. K. Examine the effectiveness and efficiency of internal controls. Note that G, I, J, and K are tested at a proficient level, which means that you should know that content in greater detail as well. All other syllabus objectives should be studied at a high level, general level, so just to get a surface level knowledge of those topics. This domain is one of the most important domains to study for the CIA exam Part 1 because remember, it comprises 35% of the total score for Part 1. So you really want to make sure that you understand this information. What is corporate governance? Corporate governance is the method by which a firm is governed, directed, administered, or controlled. Corporate governance sets the tone at the top of the organization and sets the stage for the entire organization. The board of directors, company management, shareholders, and other stakeholders all play a role in achieving strong corporate governance. A weak form of corporate governance can cause multiple problems in an organization. So a weak board of directors that does not aim to achieve the objectives and goals of the company promotes weak corporate governance. There are 8 main corporate governance principles that lead to strong corporate governance. Number 1, the board of directors approves corporate strategies that are intended to generate value for the organization. This means that they select and oversee the CEO and senior management for leading the organization. And the board of directors set the tone at the top for ethical behavior. This means that the board of directors embodies ethical behavior, and this behavior is expected to trickle down from the board of directors to senior management and to other employees, such as staff. Number 2, management develops and implements corporate strategy and operates the company's business under the direction of board of directors. This simply means that management actually follows the board of directors' judgment and their guidance. Number 3, management produces financial statements that fairly present the company's financial and operational results. Number 4, the audit committee retains and manages the relationship with the external auditor, oversees the company's financial statement audit and internal controls over financial reporting, and leads the company's risk management and compliance program. Number 5, the governance committee of the board shapes the corporate governance of the company. This means that they strive to build an engaged and diverse board. So they may conduct succession planning for the board of directors members. So if a certain member is going to retire or just decides to leave the board of directors, that means that that governance committee will be in charge of finding that next replacement person. Number 6, The Compensation Committee of the Board of Directors develops and implements an executive compensation philosophy and policy for top management to incentivize and create long-term value. So in order to attract the best talent for your CEOs, CFOs, the Compensation Committee is in charge of executing and developing a philosophy and policies to attract that top management. So they may have certain compensation packages or benefits packages that may be more enticing for people to join the organization. Number 7, the board of directors and management and shareholders should engage with each other to discuss areas of concern. As you may see by now, it's not just the board of directors who are in charge of doing the work, but there should be a synergy or harmony between the board of directors, executive management, and the shareholders who discuss concern and issues with each other so that they can ultimately be resolved and so that the organization can achieve its goals. And finally, number 8, the board of directors should consider shareholders, employees, customers, and suppliers' interests. So not only considering their concerns, but also considering their interests, such as what are their objectives and goals for the organization? What do they actually want the organization to accomplish? Now, what are the components of corporate governance? The 4 major groups needed in setting the stage are shareholders, the board of directors, managers, and employees. An organization's articles of incorporation and charter issued by the state govern these 4 groups and give the organization the right to exist. Shareholders are the owners of a corporation. They ultimately have control over the corporation. The board of directors is the governing group to oversee the management of the corporation. Management is the group of individuals that are hired by the board of directors to run the company and to manage day-to-day operations. Employees are hired by the organization and management to perform the operational daily work. What are some corporate governance problems? First, lack of board independence. If the board of directors are not independent, that means that they can easily be influenced by management, by the chief executive officer, or by activist groups. This is not what you want. A second potential problem is that there's a separation of ownership from control. So those who own the corporation should not also control the corporation. Remember, shareholders own the corporation, but they should not completely be controlling the corporation. That is the responsibility of management. Number 3, there could be an appearance of conflicts of interest situations. Number 4, there could be an occurrence of insider trading scandals. So this ultimately is fraud. So we don't want any fraudulent situations in the organization. Number 5, presence of activist shareholders and directors. What this means is that maybe shareholders and directors are not only performing their duties, especially directors, they're not only trying to govern the company, but they're also trying to get their self-interest in there as well. So they're mixing their personal interests with the corporate interests, which could lead to a lot of corruption and conflict. Number 6, there may be a lack of reasoning skills in the board members. So you want your board members to be able to take in all information and then make an objective and fair resolution or come up with ideas that are actually reasonable, that are actually doable by the company. And number 7, there could be incomplete proxy materials. So there are many more examples of corporate governance problems that could occur, but these are some of the main issues that could occur when an organization has weak corporate governance. Now, let's answer some practice questions. Remember to like the video and subscribe to this channel so you can be notified of more CI exam preparation videos. Number 1, regarding risk management, de-risking does not mean A, risk reduction, B, risk elimination, C, risk mitigation, or D, risk management. So here the question is asking, which of the following does not relate to de-risking? And de-risking is basically reducing the amount of risks that you have. So in that case, A would not be the answer because de-risking does mean risk reduction. Also, C, risk mitigation is mitigating risk, so trying to get away from risks occurring. That's also not the answer. And D, risk management. Managing risks is a part of de-risking because you want to make sure that no risk has too high of a level that is uncontrollable or that could severely affect the company or organization. So that means that our answer here is B, risk elimination. Risk elimination is not truly possible because there will always be those inherent risks that cannot be controlled by a great internal control system. So that's why B is the answer. Number 2, regarding corporate social responsibility, which of the following should be the ultimate goal of corporations? Key words here are ultimate goal. So these other ones could be small goals, but we're looking for the main overarching goal for corporations. A, philanthropic goal. B, social goal. C, environmental goal. D, sustainability goal. The best way to look at these options is to figure out which of the goals is the general goal that encompasses the other 3 options. So philanthropy is, of course, a goal of many corporations. That just means that they are giving back to great causes, such as maybe homeless shelters or maybe creating homes, such as Habitat for Humanity. Social goal may be that they are trying to communicate or build relationships with the local community or with society at large. Environmental goal may mean that they want to reduce on their carbon emissions, or they want to build trees or, grow trees, things like that. Sustainability goal here is the more overarching goal because sustainability impacts the environmental side, the social side, and the philanthropy side. So that is why D, sustainability goal, is the best answer choice here. Number 3, control self-assessments are done better when they are A, auditor planned, B, auditor controlled, C, auditor facilitated, or D, auditor design. So we're looking for the control self-assessment that is the best option. So as you may recall from previous discussions from the previous domains, auditors do not want to take the role of management, so they don't really want to control management duties. And it's okay to plan them, but that's not ideal. And it's okay to design them, but again, that's not ideal. What we want to do is facilitate those self-assessments so that management is ultimately in control, but we're giving our input here and there to say, hey, maybe we can do this better, or hey, let me facilitate this, but you give me your main objectives that you're concerned with, and let me know what you want these self-assessments to be about. What do you want them to be designed as? So we really want management to take ownership of it, but we're there to help and aid management along the way. So C is the correct answer. Number 4, which of the following is the major reason why agency issues exist? We're looking for the major reason. So these other options could be fair reasons why agency issues exist. We're looking for the overarching main reason why these agency issues could exist in a corporation. And what are agency issues? So think of agency issues as governance issues. And so let's look at the options. A, self-interest, B, owner interest, C, corporate interest, or D, community interest. So one automatically sticks out to me, and that is A, self-interest. And self-interest is where you're putting your beliefs, your values, your principles ahead of the owner's interest, the corporate's interest, and the community's interest. So owner interest is basically saying that, hey, we're looking at what the shareholders want, what they need. Corporate interest is we're looking at what's best for the overall organization. Community interest, maybe we're looking out, again, for shareholders or employees or our customers. So self-interest only benefits that one person. So that is the main reason why agency issues exist in a corporation. So A is the answer. Number 5, which of the following establishes a corporation's governance mechanism? A, shareholders, B, board of directors, C, company executives, or D, corporate bylaws? So which one establishes corporate governance? You may be a little tricked here. They're trying to trick you here because I think at first sight we would lean towards board of directors, right? Because the board of directors is in charge of governing corporate governance, or they're in charge of leading and directing the organization towards a strong corporate governance system, right? However, it's actually the corporate bylaws, which are corporate rules. So these are rules and laws that the corporation itself has established on how it wants to be managed. So actually, corporate bylaws is the answer, because that is like the playbook, or that's like the user guide, or basically it's the Bible of how the organization should be ran. It establishes the corporate governance mechanism. So D is the correct answer. Of course, shareholders, no, they don't establish anything related to corporate governance, and the executives would follow the corporate governance rules and bylaws. Number 6, an exception report for management is an example of which type of control? A, directive control, B, preventive control, C, corrective control, or D, detective control. So we're looking for an exception report. If you don't know what an exception report is, it is a report that is ran or generated that will give you a report or a list of all of the issues that have come out of whatever you're looking at. So if you're looking at a reconciliation, let's say that the system does it for you, and it might give you a list of all of the errors that have a difference or variance greater than 0. So that means that you would need to investigate it or correct it. So knowing what an exception report is, we know that the answer is not directive control, because a directive control is similar to something that would direct or guide. So such as a policy or bylaws, or, quarterly meetings that the CEO may have to direct the employees or other managers to do something. That's more so directive. Preventive would be, of course, you should already know what preventive controls are. Basically, it's an action that's performed to prevent the bad thing from happening. So an example of preventive control would be making sure that all employees have a employee badge in order to get into the building. Whoever should not be in the building should not have an employee badge. So if you're not an employee, you more than likely will not have a badge, and you will not have access to key information or confidential information that's in the employer building. Detective control, we know what that is. Basically, let's say that at the end of every day, security watches playback of the security cameras to ensure that no malice or no harm was done to facilities. That would be a detective control, because the security personnel is looking for bad things that occur during the day, and then they'll follow up on it. So now that you know all these types of controls, the best answer here is C, corrective controls. And that is because corrective controls, such as reviewing the exception report, will show you what went wrong, and then it will tell you what to do in order to correct that same control. So that is why we want to look at an exception report to correct the issue. So C is the correct answer. Number 7, which of the following is a reasonable level of risk? A, total risk, B, acceptable risk, C, residual risk, or D, minimum risk. So we're looking for a reasonable level of risk. Total risk, if we were to look at total risk, that would not be a reasonable level of risk for the company, because that would literally probably take the whole organization down, right? Total risk means that you're looking at the residual risk, you're looking at the unacceptable risks. You're looking at the risks that have been mitigated, the risks that haven't been mitigated. So that's everything. And if we accept all of those risks, this total risk, and no risk are managed by controls, then that would be detrimental to the company's existence. B, acceptable risk. This is actually the answer, because the acceptable risk is the reasonable level of risk. And think of it this way. The risk that I am willing to accept, or the risk that management is willing to accept, will not exceed my tolerance level or the tolerable level of risk, right? So management may be willing to accept 20% of the risk because that will not cause any financial harm or any operational harm to the company that will make it fail, right? So this is an acceptable or reasonable level of risk. C, residual risk. Residual risk is just the risk that is left over after we have already applied all the controls that we can. Sometimes the residual risk may actually be higher than the tolerable risk. So that's why that is not the answer, because our residual risk could be lower or higher than the risk amount that we're willing to tolerate. D is minimum risk. And so again, minimum risk could not be reasonable, or it could be reasonable. We don't know in this case. So the best answer is B, acceptable risk. Number 8, which of the type of social responsibilities embraces those practices that are expected or prohibited by society, even though they are not codified into law? A, legal responsibilities. B, philanthropic responsibilities. C, economic responsibilities. Or D, ethical responsibilities. So we have a keyword here to help us out. Not. So they're telling us that this type of responsibility is not codified or documented into law. So in my opinion, that already strikes out A, legal responsibilities, because literally legal and law are synonyms. So that's a big hint there. So A is incorrect. Next is philanthropic responsibilities. So it is true that philanthropic responsibilities are not codified into law, so it could still be an option. But what makes this answer choice wrong is that there is truly no responsibility for an organization to be philanthropic, right? It's fine if they are, and there may be an internal organizational responsibility to be philanthropic. However, this is not expected by society or prohibited by society. Therefore, B is incorrect. Economic responsibilities. So economic responsibilities, think of those as saying like, okay, it's our responsibility to keep this company afloat, to make sure that we're making a profit, we're not having a net loss, etc. That is not codified into law, but it's also not expected or prohibited by society. Not society, it may be expected by shareholders, but not necessarily by society. And so that is why the answer is ethical responsibilities. And ethical responsibilities, of course, are not codified into law. However, society does have an expectation that these ethical norms, standards, and expectations reflect a belief of what consumers, employees, shareholders, and the community regard as fair and just. So they're all about keeping the respect of shareholders, stakeholders, moral rights. So that's why the answer is D. Number 9, the purchase of insurance is a common form of A, risk transfer, B, risk retention, C, loss control, or D, risk avoidance. So here we're looking at insurance. Insurance. You may actually have insurance if you think of medical insurance. So there could be a possibility that you may have a major medical cost that comes up in the future. And so in order to prevent you paying that full cost of that medical procedure that you may need, you buy insurance so that a portion will only be paid by you and the majority of that cost is paid by an insurance company. So that's just a day-to-day real life example of how insurance works. For companies, it could be property insurance, etc. So it's a form of a risk transfer because instead of the organization taking on that total cost, they're going to transfer that risk to another third-party organization or the insurance company. It is not a form of risk retention because risk retention, think of retain. The company does not want to retain that risk. They are trying to pass it on to the other third party. Loss control, that may be a tempting option, but loss is defined as, or in this term, it's thought of as, think of a hurricane or some kind of major natural event, such as a storm, hurricane, maybe a fire that happens, and it causes a loss to occur, like a loss of property, loss of goods, loss of assets, etc. So loss control is just trying to control the risks or mitigate them or reduce them. It does not involve purchasing insurance. Risk avoidance, again, this doesn't involve purchasing insurance. This is trying to avoid risk at all costs. So maybe an example of this could be not pursuing a project or a initiative, such as not purchasing another company, or maybe not divesting a company that you currently own because you want to avoid from, in the case of purchasing, you want to avoid the risk of getting a new company or buying a new company and not getting any return from that purchase. For divesting, you want to avoid maybe losing out on profits or your brand reputation by divesting that company. So the answer here is A, risk transfer. Number 10, which of the following is not a major shareholder initiative? A, rise of shareholder activist groups. B, shareholder lawsuits. C, shareholder initiated golden parachutes. Or D, shareholder annual meetings. We're looking for the one that is not a major shareholder initiative. So the rise of shareholder activist groups is a major initiative to express shareholders' concerns about how an organization is ran or operated. So this is a major shareholder initiative. So A is not correct. B, shareholder lawsuits. Lawsuits are becoming a way for shareholders to express their frustration and concern about not being heard or not getting the anticipated results from that organization or from that board of directors or management. So this is a major initiative for shareholders. C, shareholder initiated golden parachutes. So if you don't know what a golden parachute is, it's basically a contract where the organization or corporation agrees to make payments to key management and senior officers. So think of the CEO or CFO in the case of a change in control occurring. So if the company is bought or acquired by a different firm, then there could be a chance that this golden parachute would basically save the CEO and CFO from losing out on their money at the end of the year, their annual salary. They would get this lump sum of money where they could, benefit financially. So I'll discuss that later in more detail, but let's look at D. D, shareholder annual meetings. So annual meetings are actually very key to the success of shareholders because this is where shareholders can influence or vote on certain amendments to the bylaws, or can also vote for certain directors to be on the board of directors. So those annual meetings are big initiatives for shareholders. And I mean, if you invested in a company, I'm sure that you want to vote on who sits on the board of directors or how the company is governed, all of that. So the answer here is C, shareholder initiated golden parachutes. Those large sums of money and those contracts that govern how much executives get paid in the event of control changing of the company are not shareholder initiatives. Those are managed by management. So that is not what shareholders are concerned with. So the answer is C. Number 11, this is the final question. A corporation must be managed on which of the following principles? A, corporate law, B, corporate governance, C, corporate control, or D, corporate ethics. So we're looking at which one manages the corporation. And this should be pretty easy. So corporate law is incorrect because that basically just tells you the laws for that organization and what's illegal and what is legal. Of course, the company should follow the law, but this does not guide or direct an organization. Basically, the law just states what should be done to be in compliance with regulations and the law. Next option, corporate governance. Corporate governance is actually the correct answer because for a corporation to be legitimate, its governance principles must correspond to the will of the general public. Therefore, a corporation must be managed on corporate governance because it defines the roles of the shareholders, directors, officers, and managers in corporate decision-making and accountability. Corporate control is not the answer because that's concerned with acquiring and managing the resources that are needed to operate that corporation effectively and efficiently. So control is important, but that should not be the ultimate manager, or that should not be the ultimate thing that the corporation is managed on. Corporate ethics, of course, a corporation we hope would be ethical, right? That means doing what's right or good for employees, customers, the community, being ethical and not unethical, but this is not what a corporation should be managed on. So again, the answer is B, corporate governance. All right, thank you so much for watching and tuning in to Domain 5. Please be sure to read your study book, to watch your video lectures, to take notes, and even watch this video again if you need to. Corporate governance is huge. Risk management is huge, and internal controls are huge for CIA exam part 1. So you want to make sure that you really understand this information. Go line by line by looking at the syllabus objectives to understand what you know, what you're confident in that you know, and look at what you're not so confident in knowing. So if you are struggling with a certain topic or a certain syllabus objective, focus on that area of concern so that you can pass this domain. Because remember, I'll say it for the third time, this domain comprises 35% of the total exam. So this could mean passing or failing. So thank you for tuning in. Be sure to like the video, subscribe to the channel, and comment below on how many you got right, how many questions you got wrong, and what's your plan for attacking Domain 5. Stay tuned for Domain 6 coming up. And be sure to also consider becoming a channel member by clicking the join button below. And you can join, become a channel member, and get exclusive benefits that other viewers will not. So again, as always, stay blessed and stay boss C.